Listen closely, traders, because what I'm about to tell you contradicts everything you are seeing on your screen right now. Sterling is bouncing, momentum is green, but we are heading directly into a high probability trap zone. Most retail traders are about to get run over by chasing this Gulf risk headline. I'm seeing a massive liquidity grab forming right above current prices, and I want to show you exactly where the smart money will start unloading their long positions on the latecomers. There is one danger zone and one hidden opportunity today. I'll show you both. Keep watching because I'm handing out 3 exact entry and exit levels you can plug into your platform immediately. We are taking a hard look at the cable chart with instant market verdict time. The session bias for London close is cautiously fading the spike. We are trending up, yes, but extended. The volatility from the geopolitical risk assessment in the Gulf and the noise around UK politics is creating a widening range, which historically sets up a mean reversion trade, not a trend continuation trade. I want you to write this number down. The invalidation level for the entire bearish thesis is 1.3696. If we get a 4-hour candle close above 1.3696, the resistance structure is broken, and you must stop trying to short this pair. Until that level falls, I am treating this entire rally above 1.3600 as a liquidity grab engineered to trap breakout buyers before the drop. Let's dive into the technical deep dive. Because the multi-time frame alignment here is screaming exhaustion, not strength. Looking at the weekly chart, we are pressing against a massive descending trendline resistance. The 200-week moving average is sitting far lower, so we are trading at a significant premium to long-term value. Zooming into the daily chart, we can see the 20-day moving average is steeply sloped upwards, but price is so far detached from it that a rubber band snapback is statistically imminent. The 60-day average is providing a dynamic anchor, but it's the structural overhead supply between 1.3665 and 1.3696 that is the brick wall today. These are the February highs, and price memory matters. This is where sellers are hiding. Now, dropping down to the 4-hour chart, this is our execution playground. The MACD is curled well above the zero line, which looks bullish on the surface, but here's what most traders miss. Look at the histogram and the signal line. We are seeing a clear negative divergence. Price is making a higher high, but the 4H MACD is flattening and threatening to roll over. Buyers are exhausted. They have pushed price up on the Gulf risk headline, but the momentum is bleeding out. The RSI is banging against the 73 level, deeply overbought. On the 60-minute chart, the short-term moving averages are acting as a slingshot, but they are about to lose their grip. The 20-hour average is currently resting near 1.3600. If we break below that, the trap is sprung, and the target. Now, let's look at the fundamental driver and the cross-linkage narrative. Yesterday's bid for the pound wasn't a fundamental love for the British economy. It was a risk proxy play mixed with a knee-jerk reaction to Gulf tensions. But the pound sterling to US dollar is not a safe haven. It is a high beta currency pair that gets smoked when fear really spikes. The dollar index is telling us a critical story. The DXY is trying to find a floor right where the S&P 500 is topping. If stocks roll over, the dollar catches a bid, and cable gets obliterated. We are watching that euro to pound sterling fracture as well. The ECB is in a different timeline. If the eurozone shows structural weakness, flows don't go to the pound, they go to the king dollar. The Bank of England narrative has also been fully priced out for the near term. We know the hawkish hold, we know the politics. There is nothing new to drive this above 1.3700 unless we get a complete dollar collapse, and the DXY support zone is holding firm right now. The exact event that invalidates a bearish reversal thesis is a close above 1.3700 on a daily basis, driven purely by a sharp rate differential widening in the UK's favour. Most people will skip this next segment, but this is where the money is made. Keep watching because I'm about to lay out the rules of engagement for 3 distinct strategies. This is tactical execution, not just theory. Strategy 1 is the sniper. This is the conservative. Sit on your hands until enter here. You wait for the liquidity grab to complete. The trigger condition is a definitive rejection of the 1.3655 to 1.3665 zone on the 4-hour chart. I want to see a wick that pierces above 1.3660 and then a violent 4-hour closeback below 1.3630. Once that false breakout is confirmed, you enter short at a retest of 1.3634 or a break of 1.3620. Your stop loss goes above the wick of the trap candle, so let's call that a hard stop at 1.3671. This protects you from any late-stage injection of liquidity. Your first target is the daily support at 1.3524. That is a comfortable target with a risk-reward ratio of roughly 1 to 3. If we slice through 1.3524, the second target is 1.3493. Do not move your stop to break even until the 1.3524 level prints. What voids this setup? A slow grind higher without a wick. If we just drift gently above 1.3665 without a sharp trap formation, the algorithm is trending, and you do not fight it. Strategy 2 is the active trader. This is the mean reversion standard setup for those who want to ride the momentum shift in real time. You're looking for the breakdown of the 60-minute trend. The entry condition is a break of the short-term support at 1.3589 with a strong volume spike. You don't wait for the big resistance trap. You're siphoning momentum, you step aside. Target 1 is the overnight swing low at 1.3550. Let's see how aligned we are. Before I give you the second target, type your cable range for tomorrow in the comments right now. I'm reading them to see if the community is seeing the same direction. Once target 1 at 1.3550 is hit, move your stop to break even and let the runner go for target 2 at 1.3524. This gives you a trailing stop mentality where you cannot lose once the first target is secured. Strategy 3 is the aggressor. This is the high-risk short that tries to front-run the traps. Right now, while price is hovering near 1.3634, but only if you see a volume divergence on the tick chart. This is a limit order style entry, setting a short right at 1.3655 with a razor-thin stop at 1.3675. You are fighting the trend, trying to sell the absolute top of the volatility spike. Your target is just the quick momentum burst back to 1.3600. This is a scalp, not a swing trade. Only for those who know how to lose small and manage risk aggressively. If the market stays bid and prints above 1.3675, you are wrong, and you take the loss instantly. No averaging down risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact UK news. Stops are non-negotiable, and slippage is real in this pair. Let's close this out with your retention loop. The one critical level to sleep on for the next London session is 1.3665. That is the line in the sand. Tomorrow, we are laser-focused on the UK retail sales data and whether it forces the bow's hand. We will also be looking at the DXY reaction to the US consumer sentiment to see if the dollar kills are real. If you want the full breakdown on euro to US dollar and the DXY fracture that is fueling this cable move, that video is live right now. Click the end screen to jump into the dollar index analysis. Smash the like button if this analysis gave you a clear plan and a stop loss. Subscribe and hit the bell for a daily view of all 8 assets. The liquidity trap is set, trade safe, and I will see you in the next one.